I know you have suffered from inflation. Inflation refers to the general increase in prices of goods and services over time. Inflation causes the prices of bread, milk, eggs, as well as a haircut or a plumbing repair to increase. One of the primary causes of inflation is excess demand relative to supply. When consumers have more to spend than there are services available, prices begin to increase due to the high demand. This phenomenon is known as demand pull inflation, and it is caused by factors such as an increase in consumer or government spending or export demand. Another significant cause of inflation is cost push inflation, which occurs when the cost of production for goods and services increases. This can be due to rising wages, higher raw material prices, or increases in taxes or regulations. When businesses face higher production costs, they push these expenses onto consumers in the form of higher prices, leading to inflation. Additionally, inflation can also be triggered by monetary factors, such as an increase in the money supply. When central banks print more money or lower interest rates to stimulate economic growth. This can lead to excess liquidity in the economy, causing prices to rise because the value or buying power of your currency decreases. Finally, inflation expectations can also play a role in inflation. If consumers and businesses expect to pay more for goods and services in the future, they may adjust their behavior by demanding higher wages, or by raising prices, which can become a self-fulfilling cycle of rising prices. And now the question I'm sure you are thinking about. How can I beat inflation and preserve my wealth? Historically, there are several methods used by wealthy people to build their assets. One of the most common ways people built their wealth is through entrepreneurship. Many individuals started their own businesses or invested in startups that grew into successful, profitable ventures. By taking risks, working hard, and staying focused on their goals, these individuals were able to build their own wealth rather than relying on a traditional salary or income. Another strategy people often use to build wealth is investing. By investing in a diverse range of assets such as stocks, real estate, and bonds, people were able to accumulate wealth over time through compounding returns. This strategy requires patience and a long-term outlook. In addition to entrepreneurship and investing, many individuals built their wealth through strategic career choices and opportunities. By pursuing high-paying careers in industries such as finance, technology, or healthcare, individuals earned significant incomes they then invested and grew over time. Now, what about you? If you are currently employed, you probably do not want to start a new business. Nor do you want to prepare for a new career. This leaves investing. You probably want a fairly safe investment that will earn a good rate of return, certainly higher than the rate of inflation. Let's consider the major areas of investment, which are stocks, bonds, and real estate. The average yearly return over the last 10 years for the Standard & Poor's 500 stocks has been 15.62%. That's a very good return, far above the average inflation of around 3%. Over the last 10 years, corporate bonds have yielded between 4 and 5% per year. Slightly ahead of the average inflation rate, bond yields are nothing to brag about. Comparable to bonds, home values have increased between 3 and 5% per year over the last decade. However, along with appreciation, rental income adds to the overall return on residential rental properties. Annual rental income for residential homes ranged from 5 to 7.5% of the home's value. So, for residential rental properties, the return on investments ranged from around 8 to 12.5%. This puts investing in residential rental properties in a strong second place after stocks. With this in mind, diversifying your investments between stocks and residential income properties seems like a wise investment choice. Now, you may be thinking that it takes a lot of time and money investing in and managing residential rental properties. And that was true before fractional real estate investing became popular. Now, for as little as $100, you can begin investing in rental properties. You can now buy fractional shares in rental properties that are managed by a professional management company. You benefit from both rental income and property appreciation. These real estate investment trusts have become the favored way for average individuals to benefit from rental income properties. There are many real estate investment trusts you can choose from. You can choose to invest in individual properties, or you can invest in the entire portfolio of properties. Here's what I mean. On one hand, most real estate investment trusts offer shares in individual properties. Your shares entitle you to benefit from the rental income and appreciation of that property. To diversify your investments, you purchase shares in several properties. On the other hand, the trust may offer shares in their entire portfolio of properties. The trust may purchase new properties, and you will benefit from your share of the rental income and appreciation of all the properties they manage, including newly purchased properties. Let's look at an example of the first kind of trust. Suppose you purchase shares in 3 individual properties. And suppose one of those properties becomes vacant when the renter moves out. During the time the management company is searching for a new renter, that home produces no rental income. Your income from rents may drop by 1/3 until a new renter is found. But in the second case, a real estate investment trust may own 100 properties. When a renter moves out of a home, your share of the total rental income will drop only slightly until a new renter is found. Your share of all the rents produces a more steady and reliable income in this case. Personally, I favor purchasing shares in an entire portfolio of rental properties. This makes my income more stable and reliable. And it automatically provides diversification without having to invest in multiple individual properties. Many investment advisors suggest that 10 to 15% of the average person's investments should be in income-producing real estate. If you want an easy way of investing some money in residential rental real estate, I suggest looking at the real estate investment trust I use. Visit fractionalinvesting.online to see how easy getting involved in creating a safe residual income can actually be. If you choose to invest, you'll receive $25 you can use to begin your real estate investment journey. You'll be glad you did.